All right, let's talk about something that most investors completely overlook. While everyone is chasing $300 AI stocks and $500 mega caps, the real asymmetric opportunities, the ones that can potentially 5x or even 10x, are often sitting quietly under $10. And February 2026 could be a major turning point for small cap and cheap stocks. We're seeing rotation into higher risk assets, improving small cap sentiment, and strong momentum in specific sectors like nuclear energy, EV infrastructure, biotech, and turnaround growth plays. This is a must-watch if you're serious about high-risk, high-reward investing, because the stocks we're covering today are real companies trading under $10, with real catalysts and real upside potential. Before we jump in, quick favor. Let's get this video to 500 likes. If you appreciate deep small cap research without hype and nonsense, hit that like button right now. And if you're not subscribed, subscribe and turn on the bell notification. When cheap stocks start running, timing matters. Now, very important. I am not a financial advisor. This is not financial advice. Penny stocks and small cap stocks are volatile and risky. You must do your own research and only invest money you can afford to lose. All right, let's get into it. First stock, Energy Inc., NYSE American, URG. As of early 2026, Energy has been trading in the $1 range. That alone puts it firmly in cheap stock territory. But this is not a random shell company. This is a US-based uranium producer. Why does uranium matter right now? Because nuclear energy is back in the global conversation. Countries are trying to secure domestic energy supplies. The United States has been actively discussing reducing reliance on foreign uranium imports. When governments prioritize domestic supply chains, smaller U.S. uranium producers suddenly become strategic assets. Energy operates the Lost Creek project in Wyoming and has production capabilities in place. That's key. They are not just an exploration concept, they are an operating company. Market cap remains in the small cap range, which means volatility is high. But that also means upside is significant if uranium prices remain elevated. The uranium spot price has been strong relative to prior years, and if that continues, revenue potential expands. This stock doesn't need uranium at record highs to move. It needs continued sector momentum and capital inflow into nuclear energy plays. If sentiment shifts aggressively bullish on nuclear in 2026, small producers like URG can move fast. Second stock, Blink Charging Co., NASDAQ, BLNK. Blink has traded under $10 and represents an EV infrastructure growth story. The EV market isn't just about Tesla or major automakers. Infrastructure is critical. Charging stations determine whether EV adoption scales efficiently. Blink builds, owns, and operates EV charging equipment. The company has expanded its network across the US and internationally. Revenue growth over the past few years has shown expansion, although profitability has been challenging, which is common in growth stage infrastructure companies. Under $10, Blink becomes interesting because sentiment has already priced in a lot of pessimism. If revenue growth stabilizes and losses narrow, valuation could re-rate. EV infrastructure spending hasn't disappeared. Government clean energy incentives still exist. If federal or state-level EV initiatives accelerate again in 2026, infrastructure names could catch a second wave. Blink is volatile, but volatility is where opportunity lives in cheap stocks. Third stock, Rocket Lab USA, NASDAQ RKLB. Rocket Lab is traded under $10 and operates in the space launch and aerospace sector. This is not a meme stock. This is a real aerospace company providing launch services for small satellites. The space industry continues expanding, driven by satellite deployment, defense contracts, and private sector innovation. Rocket Lab has successfully completed launches and is building out its Neutron rocket program. Market cap remains far below mega-cap aerospace players. That's important. If Rocket Lab secures additional government or defense contracts, revenue growth acceleration could dramatically shift investor perception. Space is a long-term theme, and when growth sentiment returns to speculative sectors, space stocks can move aggressively. Fourth stock, SoFi Technologies, NASDAQ, SoFi. SoFi has traded under $10 and represents a fintech growth story. Unlike many speculative cheap stocks, SoFi generates significant revenue and has expanded its product ecosystem, including lending, banking, investing, and financial services. The key with SoFi is profitability progression. If SoFi continues moving toward consistent net income and improves margins, the market may begin valuing it more like a financial institution rather than a speculative fintech startup. Interest rate trends also matter here. If rate environments stabilize, loan growth visibility improves. SoFi's user growth metrics have historically been strong, and cross-selling across its ecosystem adds long-term potential. Under $10, SoFi offers exposure to fintech innovation without paying premium multiples seen in past years. Fifth stock, Ocugen, NASDAQ OCGN. Ocugen trades under $5 and operates in biotech. This is high-risk territory. Biotech is event-driven. Stocks move based on clinical data, regulatory updates, and partnerships. Ocugen focuses on gene therapies and ophthalmology-related treatments. The reason biotech under $10 is interesting is simple. Small market cap plus clinical success equals explosive upside. But let's be real. Clinical setbacks can crush these stocks. That's why position sizing and risk tolerance are critical. What makes biotech powerful is asymmetry. If a therapy shows positive trial results, institutional interest can flood in quickly. Now let's zoom out. Why are under $10 stocks attractive in February 2026? Because small cap rotations tend to happen quickly. When macro sentiment shifts toward risk on, capital flows from large caps into mid caps and then into small caps. Cheap stocks often move last, but they move hardest. These stocks don't need perfect fundamentals. They need improving narratives and confirmed catalysts. For uranium, the catalyst is energy security and uranium pricing. For EV infrastructure, it's adoption and policy support. For space, it's launch success and defense contracts. For fintech, it's profitability progression. For biotech, it's clinical milestones. The common theme? Each one has a story that could shift rapidly. Now let's talk risk management. Cheap stocks under $10 are volatile for a reason. They are small cap, sensitive to dilution, earnings misses, and macro pressure. You cannot treat them like blue chips. Smart investors scale positions. They don't go all in. They manage exposure. They understand that a 20 to 30% pullback is normal in small caps. The goal isn't guessing. The goal is positioning ahead of catalysts while controlling downside risk. And here's something important. Price alone does not determine value. A $2 stock can be overvalued. A $200 stock can be undervalued. What matters is market cap relative to future growth potential. That's why we look at revenue growth, sector tailwinds, and catalysts. If even one of these stocks executes strongly in 2026, the upside from current levels could be substantial. But again, I'm not a financial advisor. This is not financial advice. Do your own research. Read earnings reports. Review SEC filings. Understand the risks. Now I want to hear from you. Which of these under $10 stocks do you believe has the biggest upside? Which one do you think is too risky? Rank them in the comments. And if you want more deep small cap breakdowns, make sure you like this video, subscribe, and turn on notifications. Cheap stocks can be dangerous, but they can also be life-changing if approached correctly. February 2026 could reward prepared investors. Stay disciplined, stay informed, and I'll see you in the next one.